The world's most powerful currency isn't printed anymore. It's typed, and most of it was created in the last few years, quietly with a keystroke. No gold, no vault, just trust. That sounds abstract, until you realize your savings, your salary, and your future plans all sit inside that system. Right now, for centuries, power looked like weight. Gold bars, heavy, inconvenient, honest. You couldn't fake it easily, and you couldn't print it faster just because you needed to. Empires rose on gold, and collapsed when they ran out. Then came the dollar, not backed by gold anymore, but by something more powerful. Belief, military reach, and the promise that the U.S. would always pay its debts. After World War II, the dollar became the global referee. Oil was priced in it. Trade settled in it. Countries held it like insurance, and it worked, mostly, until the math got uncomfortable. In 1971, the dollar quietly cut its last tie to gold. From that moment on, money became elastic. Governments could spend first and explain later. Debt grew, slowly at first, then fast, then exponentially. Today, U.S. debt is over $30 trillion. That number is so large it stops feeling real. But the interest on it is very real, and it compounds. Here's the hidden mechanism. When new dollars are created, they don't appear evenly. They enter through banks, markets, and governments first. Asset prices rise. Stocks, real estate, bonds. If you own assets, you feel richer. If you earn wages, you feel left behind. Same system, different outcomes. This is where gold re-enters the story. Gold doesn't generate yield. It just sits there, quiet, almost boring. And that's the point. Over long periods, gold doesn't make you rich. It stops you from getting poor. When currencies weaken, gold remembers. But gold has a problem. It doesn't move at the speed of the internet. You can't send it across borders in seconds. You can't program it. In a digital world, gold feels heavy again. Enter crypto. Bitcoin arrives in 2009, right after the financial system nearly collapses. The timing wasn't an accident. Its pitch was radical but simple. Fixed supply, no central authority, rules instead of rulers. 21 million coins, ever. That number is the entire marketing department. Crypto promised an escape from money printing, from political discretion, from trust. And for a moment, it felt like a revolution. Prices exploded. New tokens appeared daily. Some brilliant, some absurd. A lot of hype. Here's the irony. Most crypto doesn't escape the system. It recreates it. Leverage, speculation, insider advantages, centralized exchanges. Human behavior didn't change. It just got faster. Bitcoin is different. But even Bitcoin trades like a risk asset. When fear hits, it drops. When liquidity flows, it rises. Not because the idea failed, because markets are emotional. Quietly, central banks have noticed. Over the last few years, they've been buying gold again. Not headlines, balance sheets. At the same time, regulators circle crypto, not to kill it, but to contain it. Power prefers borders. Code doesn't. So who really holds the power? The dollar still runs the plumbing of global finance. Gold still anchors value when confidence breaks. Crypto exposes the cracks and experiments with alternatives. None of them are winning outright. They're checking each other. The real risk isn't choosing the wrong asset. It's assuming any one of them is permanent. History says money always changes, usually during stress, usually faster than people expect. So here's the uncomfortable question. If trust is the real currency and every system relies on it, what happens when trust starts to fracture at the same time in governments, institutions, and technology? And when that moment comes, what will people reach for first?